Hello, and welcome to episode 123 of the REconomy Podcast, where we discuss economic issues that impact real estate, housing, and affordability. I am Odeta Kushi, Deputy Chief Economist at First American, and here with me is Mark Fleming, Chief Economist at First American. Hey, Mark, I'm sure you've heard the outdated real estate adage, marry the house, date the rate.
Hi, Odeta. I sure have, and I'm glad you called it outdated because that advice made lots of sense during the 4-decade stretch of declining mortgage rates that ended just a few years ago. Buyers could lock in a rate and refinance later at a lower one. That long-run rate decline, though, helped fuel lots of housing turnover.
Yeah, I mean, consider it was 18% in 1981 and then all the way down until we hit 2022 and it went right back up, and times have since changed.
Exactly.
Rates have remained between 6.5% to 7% for some time now, and 81% of existing homeowners, according to the first quarter 2025 data from the National Mortgage Database, have a rate below 6%. And if you haven't guessed it by now, today's episode is all about mortgage rates, how they're determined, where they might be headed for the rest of the year, and whether rate changes will be the main driver of housing market activity in the second half of the year.
Spoiler alert, we don't think so.
That's right. So let's start with the basics. How are mortgage rates actually set?
Yes, contrary to popular belief, mortgage rates aren't set by the Federal Reserve. The Fed influences short-term interest rates, but mortgage rates, especially the 30-year fixed-rate mortgage, tend to follow the yield on the 10-year Treasury note.
Right. And that 10-year yield reflects investor expectations about inflation, economic growth, among other factors like geopolitical conditions and beyond. Lenders then add a spread to that yield to account for the risks associated with investing in mortgage-backed securities, or MBS. We have a whole REconomy episode dedicated to explaining the spread and multiple blog posts, I think. So check out episode 71 for more on the spread.
Yes, and historically, that spread has averaged around 1.7 to 2 percentage points. So if the 10-year Treasury is at 4.5%, mortgage rates might land somewhere around 6.2%. But that spread isn't fixed. It can widen or narrow depending upon market conditions.
Exactly. For example, during periods of financial stress or uncertainty, like the banking sector jitters in early 2023, spreads widened. Spreads actually peaked at 3.15 percentage points in May of 2023, but have since come down to 2.44 percentage points. And that matters a lot. Consider that the 10-year was at about 4.2% in the week ending August 8th. If spreads were still at that high of 3.15 percentage points, then the 30-year fixed-rate mortgage would be over 7% right now.
Yes, conversely, if the spread was at the historical norm of 1.7 percentage points, rates would actually be below 6% right now.
That would be so nice. But instead, we're somewhere in the middle with a rate of 6.7%. From that high point in 2023, we've seen spreads narrow a bit as inflation has cooled and market volatility has eased, which allows mortgage rates to come down even if the 10-year remains elevated.
True, though we're not expecting the spread to come back down to normal this year for some reasons we mentioned in the podcast episode we just referenced. Specifically, the Fed is unlikely to become an MBS buyer again, and arguably slower prepayment rates and longer duration on mortgages are here to stay.
And if you have no idea what we mean by that, seriously, check out that episode
Exactly,
because we
yes.
actually explain what these things mean. But that brings us to our next question. Where are mortgage rates headed for the rest of the year?
Yes, the question that is on everybody's mind, it seems, because mortgage rates are tied to movements in the 10-year Treasury, which is influenced by all sorts of factors. There's really no way to know for sure. See where I'm heading here?
Yeah, I do.
Exactly. But we can talk about what could contribute to movements higher or lower. Higher inflation or inflation expectations could drive yields up and therefore mortgage rates higher. Conversely, a weaker economy or labor market might push yields down and by association, mortgage rates lower. Classic economist on the one hand and the other.
Yeah, you are so committed. But I mean,
Exactly.
if anyone really thought we'd have a point forecast that
They're
we
crazy.
are confident about for mortgage
Yeah.
rates, that's a tough one to get right.
Yeah.
But industry forecasts suggest that the average 30-year fixed rate mortgage will land around 6.6% by year end, with a range between 6.4 and 6.7%. Futures prices as of early August implied a rate of about 6.4% by the end of the year. And some of the recent decline in rates in early August was due to a weaker jobs report and negative revisions to that jobs report. So basically, the markets thought it pointed to a weaker labor market, and they increased their odds that the Fed would cut rates at their September meeting.
Yeah, right now in mid-August, the market probability of the Fed cutting rates by 25 basis points in September is 96%. That's pretty much a sure thing, right? According to the CME FedWatch tool. That's up from 64% in early July. So those recent data reports have certainly sort of changed the tune of how people think how likely it is that a rate cut will happen in September.
And mortgage fell on that news. And we've seen this before, rates moving ahead of Fed action.
That's right. In mid-2024, mortgage rates dipped before the Fed's 50 basis point cut in September. Markets anticipated easing and rates responded early. We're seeing a similar pattern now. Rates have softened slightly since the July jobs report hinted at a cooling labor market.
But that can work the other way too. If the Fed does cut rates in September, it doesn't mean mortgage rates will fall. That's also what we saw last year. Mortgage rates fell in anticipation of the cut, but actually increased after the Fed cut.
And that's because of the 10-year yield. If investors aren't convinced that inflation is under control, then you'll see that reflected as a higher yield.
And there are a lot of unknowns about inflation right now. We need to wait and see how tariffs impact inflation in the second half of the year, and we need to see how labor market conditions evolve. And then, of course, how the Fed acts when its two goals of maximum employment and price stability are in tension.
And all of this uncertainty is why most economists aren't expecting rates to move around too much. We've already seen a modest rate benefit due to the July jobs report, but even that hasn't really pushed the mortgage rate below 6.6%.
True. So when it comes to the second half of 2025, is it all about rates?
I thought you would never ask, Odeta. Listeners may be surprised to hear that I think not. While lower rates can help convince that on-the-margin buyer or seller, it's unlikely to unlock the majority of sellers. Remember that stat. 81% of existing homeowners today have a rate below 6%. They're unlikely to be incentivized to sell even if rates fell to 6.4%.
Well, to test that assumption of yours, I did a very simple analysis to see how rate-sensitive potential buyers are in today's market. I looked at the relationship between purchase mortgage applications and the 30-year fixed-rate mortgage from 1990 through today, and identified 8 different historical, what I'm calling regimes. So I'll walk through them very quickly, but in the early 90s, I've got the early 1990s recession regime, the 95 to 2001, I'm calling it the late 90s boom. Of course, 2002 to 2006, it's our housing bubble regime. 2007 to 2012 is the global financial crisis and recovery. Then what I'm calling the post-GFC norm, or 2013 to 2019. And then, of course, the 2020 to 21 period is the ultra-low rates regime. 22 to 23 is the rising rates regime. And then 24 onward is what I'm calling the high plateau. And what we found is that we're currently in one of the least rate-sensitive regimes. The most rate-sensitive was 2020 to 2021.
Yeah, I love the names of these things you've given, and that makes complete sense. The ultra low, I love the name for that period. Rates encouraged moving, but it would take a big rate drop off that high plateau to entice existing homeowners to move today. And that's made worse by the economic and labor market uncertainty that's in the market today.
Right. And we're calling this the dual lock-in effect. The first lock-in effect is the one that we're all too familiar with, the rate lock-in effect. Many homeowners refinanced during the pandemic and now enjoy these ultra-low mortgage rates, averaging 4.1% for outstanding mortgages. And with current rates near 7%, moving means trading that low monthly payment for a significantly higher one, creating that financial disincentive that has frozen many would-be sellers in place and slowed the turnover of existing sales. But the frozen labor market has emerged as an additional lock-in effect. Now, while the unemployment rate remains historically low, the job hiring rate has fallen to about 2013 levels, which is when the unemployment rate was 7%. We know that job changes are a trigger for household moves. So when fewer people are switching jobs, there's less incentive to relocate, reducing both buyer and selling activity in the housing market.
Yes, but beyond the labor market, broader macroeconomic uncertainty has also unsettled potential buyers and sellers. According to a June 2025 survey by the New Home Trends Institute at John Burns Research and Consulting, Nearly half are delaying home purchases due to economic uncertainty. This underscores how sentiment, not just fundamentals, shapes today's housing dynamics.
My goodness. Negative, negative, negative.
I know. Womp, womp.
It's a lot. I think that's enough on the negative talk.
Yeah, well, it has been a little bit of a cruel summer for housing. Yeah, get it? Get it, Odeta? No?
Okay, usually when you say get it, it's because you're making an 80s reference, but all I hear when you say cruel summer is Taylor Swift's 2019 hit from her 7th studio album, Lover.
What? I don't get it. Taylor who? I'm not quite sure who that is.
You better be careful. The Swifties will come for you. And she just announced her new album. So these are important times for the Swifties.
I do know what a Swiftie is, and I do know how dangerous it is to cross one. So I'm actually referring to Cruel Summer, a 1983 hit by Bananarama. Huh? No?
If you say so, but we're going to add both songs to the REconomy playlist because currently it's very heavily 80s weighted.
Okay, fair enough. I think the safest thing here to do is move right along. You said we were being too negative, and I really agree because there are reasons to be positive as well. Real estate moves in cycles, and while existing home sales have hit a cyclical trough because of what we've just discussed, that means we're at the beginning of a new cycle. Sales activity has stabilized near a 4 million annualized sales pace, suggesting that the market has found its floor. And from here, modest gains will represent the early stages of recovery. But if not rates, then what will drive that recovery?
Well, I'm so glad you asked. We believe that more sales will be driven by life events, the 5 Ds as we've been calling them: diplomas, diapers, divorce, downsizing, and death. Listen to episode 119 in this year's summer school series for more on the 5 Ds. And sure, of course, lower rates could help. We're not going to deny lower rates. We'll take them. But we can't rely on that this time around.
I think that's a great point. Let's not rely on it. Instead, we're already seeing more sellers listing and rising inventory. This is an indication that, life happens regardless of the mortgage rate. And rising inventory has helped to ease price pressures and give incomes the fighting chance to catch up again.
Right. I mean, we often forget that housing affordability is not just about rates. It's income and house prices. And we know that nationally, house price appreciation has slowed to the low single digits. In some markets in the South and West, house prices have even declined compared to year-ago levels. So we are seeing this gradual shift, in some places a little more than gradual, towards a more buyer-friendly market.
And so on that high note, I think it's a great place to end the episode with a little cautious optimism about the start of a new cycle from cruel summer to autumn almanac.
Okay. You can't take 80s credit for that. That's definitely the 60s.
Drat, I really thought I could sneak that one by you.
That's before your time. I'm always looking out for our listeners.
Exactly.
I can't have them thinking that's an 80s songs.
Yep.
And on that old note, thank you all for joining us on this episode of the REconomy Podcast. If you have an economics question you'd like us to feature in the future, you can email us at economics@firststam.com. And as always, if you can't wait for the next episode, you can follow us on X. It's at Odeta Kushi for me and at Fleming Econ for Mark. Until next time.